4 times in 9 days. That's how many times the Iran war paused and then resumed. On Saturday night, a ceasefire framework was announced. Within hours, Iran's own military denied it. At the same time, the Federal Reserve split 3 ways. 3 major central banks all held interest rates, and US consumer sentiment posted its biggest jump in 5 months. This week didn't have one story, it had a pattern. Here's what actually happened, and why we're calling this episode The Whipsaw. MoneySpider, Watching the Financial Web, Episode 4, The Whipsaw, Signals over Narratives. While Wall Street watched the war, the economy quietly cooled. Second quarter growth slowed to 1.5%, down from just over 2%, and below expectations. The Fed's preferred inflation measure eased slightly to 3.3%. Jobless claims edged higher, but remained close to multi-decade lows. Meanwhile, the Federal Reserve held rates for a 5th straight meeting, but there was a twist. 3 policymakers wanted to raise rates, the most divided vote in a decade. That isn't really about this week's data, it's about how much weight policymakers are putting on where oil prices go next. Four of America's biggest companies reported this week, and investors split them neatly into 2 camps. Amazon's cloud business grew 37%, its fastest pace in 5 years. The company also lifted capital spending to $220 billion, and the shares were rewarded with a jump of 10%. Microsoft beat expectations across the board and rose 8%. Meta also beat on revenue growth, yet fell 8% as investors focused on its spending. Apple reported record revenue and slipped too. Meanwhile, South Korea's stock market, after weeks of heavy selling, posted its biggest one-day gain of the year. 2 companies rewarded for investing, 2 punished. The market isn't questioning capital spending itself. It's asking whose spending does it believe in. The number that surprised us most this week came from consumer sentiment. The University of Michigan's July reading rose to 55.2, almost 12% higher than June, and its strongest reading in 5 months. It's still below where it stood a year ago, but this was the biggest monthly improvement for some time, helped mainly by lower petrol prices. For the past 13 weeks, we've described the story as consumer fracture. This week's data moved clearly in the opposite direction. That's worth saying openly, rather than quietly filing it under the old narrative. A correction and a caution at the same time. The Iran war paused after the 29th. It then resumed with heavy strikes, including an attack that killed a family of 3 on Qeshm Island. Then it paused again after a single night. On Saturday evening, the US president announced that Iran had agreed in principle to reopen the Strait of Hormuz. Within hours, an Iranian military source denies the claim, saying the strait would remain closed while US strikes continued. Last week we said don't trust diplomatic announcements without checking when they actually happened. This week we are handed almost exactly the same test again. We're reporting that the claim was made. We're not reporting that it's true. Elsewhere, the Federal Reserve, the Bank of England and the Bank of Japan all left interest rates unchanged. Japan remains the one to watch. Its governor is in hospital and his deputy offered no fresh guidance. On the same night, markets suspected another currency intervention. Follow the money and the pattern becomes clearer. Oil and gold both whipsawed with the conflict. Higher when the fighting resumed, lower when it paused, more than once inside the same week. The 10-year Treasury yield climbed to 4.75%, its highest level of this cycle. The dollar had its weakest week in 3 months. Volatility jumped around the Fed meeting before falling back almost as quickly. At the same time, the forced unwinding of leveraged AI positions, which pushed one hedge fund, the aptly named Situational Awareness, to sell its entire public equity portfolio. South Korea had its biggest one-day rally after its recent shakeout. Recovery in one market, forced selling in another. Exactly the same underlying cause. Nothing settled into a trend. Everything moved and then moved back. The tension map. Let's look at the signals together. Oil, this week's clearest whipsaw. The 10-year yield still climbing. Consumer sentiment, the week's biggest surprise, breaking sharply higher. Gold drifting lower as the panic never fully arrived, and Fed expectations swinging with every twist in the conflict. The master signal this week is the whipsaw. Oil, the dollar, consumer sentiment, all moving on the same 9-day cycle of pause and resume. 4 reversals in 9 days isn't simply noise around a trend. For now, the reversal is the trend. So what should we watch next? Will Saturday's ceasefire claim hold or become reversal number 5? The US jobs report, the manufacturing survey, whether the Senate moves on the stalled war funding package, and whether the Bank of Japan's leadership gap becomes something more significant. Our confidence remains medium and deliberately capped, because the single most important fact this week, the ceasefire claim, is still disputed by one of the parties involved. Looking now at the observatory on the website. Before we finish, here's what's live on the observatory this week. On macro, we have the interest bill, the Buffett indicator, showing the market to be significantly overvalued still, and the melting anchors gold price dollar, showing the almost complete loss of purchasing power in gold terms since 1971. On micro, we have Utopia's 11. Nvidia's back in pole position there. We have the debt garden. This is a number of private credit companies that we are following. As previously said, we think that private equity and private credit is the canary in the coal mine for the next market shakeout. So we're paying close attention to those companies. Also, we have Cape Fear with the Shiller Cape ratio still in the 99th percentile. It's worth keeping an eye on that. It's not a timing indicator, but it does show that the broad market has almost never been more expensive. On Demos, we've got the mood of the crowd. This shows the big jump up to 55.2 for the University of Michigan sentiment. And the camel's back. This is where we're developing a way to look at how the younger generations are being squeezed by previous promises. On Polis, we've got the countdown clock, the watchtower, counting down to the midterms. It's only 92 days to go now. And in between that, we've got the next Fed decision coming mid-September. So we're going to be very interested to see whether the new Fed chair can keep rates down as the administration wants. On flows, we've got the net liquidity tracker and the tide table. This is looking to capture information as to where the flows going into markets are and how the growth of passive investing is interfering with price discovery. And we're also keeping an eye on the yen carry trade. there's been intervention this week to try and support the yen, where we think that it's one of the components of the financial plumbing system that could cause major upsets in markets. So that's it for this week. MoneySpider, watching the financial web. And as we always say, systems matter, systems leave signals. Until next week, keep watching the web.